Investor Connect podcast program. This is Hall T. Martin. I'm the host of the show, in which we interview angel investors, venture capital, private equity, family offices, and many other investor groups for startups and growth companies. I hope you enjoyed this episode. Thank you for joining us. Well, hello, this is Hall Martin with Investor Connect. Today we're here with James Wang of Creative Ventures. James, thank you for joining us.
Sure. Thanks for having me, Hall.
Great. Can you tell us about your background before investing in early stage companies?
Sure. I have a bit of a mixture of background between both the finance and the technology side of things. I spent a couple of years at a hedge fund called Brightwater Associates, where that really got me starting to think about risk investing and the sort of goals around that. But I also did spend some time at Google X doing a project out there, as well as doing my own startup. So it's a bit of a varied background there. And I think it is useful in terms of having perspective on seeing companies.
So what led you to start investing in the deep tech technology sector? What drew you to that area?
So the interesting thing about us is we actually started looking mostly from the market side first. So the way Creative Ventures invests is by looking at what are the biggest problems facing the world right now. And those are the places that we're going after. The way we see it, there's two real types of risks that you face in terms of trying to invest in early stage startups. There's obviously the execution risk in terms of picking the right team and everything, which everyone knows. But the other side of it is just market risk. Because if you're trying to really go after a market as an early stage investor, you need to look for something that's going to be around not just 2 or 3 years from now. You need a problem and the faith that that startup is going to be tackling something that's going to be around 3, 5, 7, 10 years from now in order to really have the returns that you're looking for. So in terms of deep tech, we didn't actually start in terms of specifically looking to get into deep technology. We started by looking at what are the biggest problems facing us. So we came out with things like, in terms of the healthcare system, we're faced with the rise of chronic disease and aging in terms of our populations across the world. We're dealing with, in terms of agriculture, the effects of climate change and just growth in terms of the prosperity of the developing world and how that's putting a strain on, say, even just nitrogen supplies in terms of actually being able to grow enough output to sustain the kind of protein input that people are getting. And also in terms of secular labor shortages for the same demographic trends that we're dealing with on the healthcare side. People are talking about how wages are rising now and how there are shortages in terms of the labor pool in different areas. But one thing that a lot of people don't realize is this is actually a secular trend that you can see going all the way back to 2000, and it's been getting worse from there. It's just that economic conditions have delayed the reckoning until around now.
So we have a lot of investors that listen to the show. What's your advice for investors who want to invest in the deep technology space?
Yeah, I think one of the big things we do hear from other investors is that we seem to be pretty fearless in terms of taking technical risks. We have, for example, a quantum computing startup right now called Bleximo, which does quantum computing ASICs, basically for drug discovery. And our answer to that and the sort of advice we give in terms of investing in the space is don't really look towards the fact that the technology is really complicated, really deep or whatnot. Really look towards the different application areas there are around it and make sure that, for one, there's a market actually there. It's not just kind of a shiny thing in terms of just being a quantum computing for quantum computing's sake, but also there's a distinction that doesn't really hold up when you're looking at different SaaS businesses versus if you're investing in something like, say, quantum computing. And that's the question of whether or not you're investing in something that's in the R&D, research and development phase, and it's a vision of something that might be one day, or if it's actually a technology that could come to market and it's just an engineering problem that you have to put a lot of effort into. We generally don't invest in things that are just pure R&D projects because it's hard to say when those will actually come to fruition. And again, it's like we want a market that'll be there in 3, 5, or 7 years from now. We don't want a technology that'll only be ready for the market in 3, 5, or 7 years from now.
Great. So let's talk about the state of investing in the deep tech space. I've seen a number of firms coming up to pursue it. How do you think the industry is evolving? Is it becoming filled out with more investors, or is it becoming more fragmented? Where do you see it going?
It definitely has gotten odder in the recent years. I would say that when we first started Creative Ventures in 2013, no one was really that interested in our space, especially sort of a year or two into it. Blockchain, crypto, that was sort of all the rage. Now, there definitely is a lot more interest in the area, and we're seeing a lot more strategic investors come in too, which has been interesting in terms of how the space is evolving. I'd say that one of the biggest changes that we've seen since the start is, again, how many strategic investors are now coming in directly into the space in terms of large corporations looking for something that'll potentially help them keep their edge or keep their business years from now. Some of our co-investors in terms of later stage capital are actually now no longer the typical players you'd expect in terms of larger growth capital VC firms. A lot of them are now actually strategic arms or even just direct corporate infusion of capital from different large players.
Great. So what's your investment thesis for this sector? I know you're looking out for very long-term problems with long-term implications, but more specifically, what do you look for in startups that you pursue in this space?
Yeah, in terms of what we look for, we actually try to start the process by figuring out what problems we're going after first. And we're trying to be better about it too, coming on podcasts like this and everything. But we're trying to be pretty open about what we're looking for. We generally pre-state what some of the problems that we're looking at, and then basically start talking to different startups and see whether they fit into those categories. We don't actually try to presuppose what the solution is. We just have some views in terms of the different areas that are interesting. So we try to figure things out, like, for example, in terms of the healthcare space, there's a lot of opportunity there. Digital health has generally been problematic, but we do see a lot of opportunity there for different areas around, say, physician burnout, physicians not being able to interact with patients versus needing to stare at their different EMR systems right now, and a lot of the different opportunities that will arise as we move more and more towards a value-based care system, and having systems that are able to automate a lot of those processes. So we have a thesis around that. We have the thesis that I had mentioned around labor saving. And we also have one around the agricultural climate and just in terms of new development in China and some of the rest of the world, and alternative proteins in terms of basically just we're going to need to figure out some sort of way of maintaining just the level of meat eating in the world and the trend in terms of more meat eating that we'll have going forward. So basically a lot of these pieces are just things that we have a lot of research in, understand really well, and then basically talk to different startups that have the same sort of visions that we have in tackling these problems.
What are a couple of startup examples that fit that thesis? Are there any portfolios that stand out as really good examples?
Yeah, so there's a couple of them that I can think of off the bat. So one is, for example, Echo Devices. They make affordable ultrasound. So whereas your typical ultrasound in a lab might cost tens of thousands to hundreds of thousands of dollars, usually closer to the latter, and be something that you need a trained tech to be operating, radiologists and whatnot. What Echo is doing is they're actually bringing that technology down to a handheld device that can be as cheap as $2,000. So imagine today, every doctor has their stethoscope. In the future, the vision is that every doctor has a little ultrasound, this handheld ultrasound. And a big part of the reason why that's important is because we're facing a lot of problems today in terms of chronic disease, and the healthcare system is trying to figure out a way of both caring for these folks and also saving money. So if you're trying to screen this many people who have these different chronic diseases that are basically ticking time bombs in terms of when they become acute conditions, you need some way of screening them and at the point of care, and ultrasound and this sort of diagnostic tool are a big part of the solution for figuring that out. Another startup we're invested in that's out here is called Vericool, which is actually a really interesting story just in the local East Bay here. Now, just in terms of the founder story. So he grew up in Richmond, is an ex-felon, and just has a very non-traditional startup background. But what the company does is they essentially make sustainable packaging that can replace EPS or styrofoam. And that was from a lot of the different sustainability trends that we saw that got kicked off by a lot of the initial climate change regulation. So we're seeing a lot of different growth in that space as well. So these are two examples, along with Bleximo, which I had mentioned previously.
So what are the challenges in investing in the deep tech space? I can imagine the long-term nature of the problems you're trying to solve, plus the magnitude of the problems can be daunting for the startup, but more specifically, what do you see as the challenges for the startup?
Yeah, I mean, there's a number of them, but I think one of the big challenges for startups in this space is because what they're tackling is usually a very large problem, and the technology they have is actually pretty flexible in terms of what it can be applied to. You can have cases where, you have Vericool, they can do various things with their technology to make some sustainable something or other. For Pleximo, obviously, quantum computing has a lot of people dreaming about all the different applications it can be used for. One of the big challenges for these startups is going to be focus. Because if you don't end up picking the right market to start with and you don't do a lot of the development towards it, it's very hard to pivot. It's not like a typical software company where you can basically re-engineer the thing if you really need to. Just make a big push, get the thing changed out in 1 or 2 months and relaunch. Here, if you end up going the wrong direction for a long period of time, you might be years out from being able to readapt your technology to this other application that you're now hoping to use it for. So I think the focus is definitely one thing that we see as a really big challenge in terms of different companies in the space.
Great. So there are many sectors in the deep tech space. There's robotics and energy, et cetera. But if you had to pick 1 or 2 applications or subsectors that were the most ripe for pursuit, what would you call them out as?
Yeah, so I'd probably say a lot of the labor savings around semi-skilled labor. So, for example, back-of-house food services. One of the companies that we have is actually one called Dishcraft, which does dishwashing robotics, where they're essentially able to take a lot of the labor out of these different hotel chains, large operations, and reduce the amount of labor needed to do dishwashing. So that's important because it's something that you still need to actually turn tables or whatnot, but it's not necessarily something that otherwise adds a lot of intrinsic value to your business. It also has a lot of turnover issues in terms of staffing too. That's not exactly desirable. So a lot of these type of labor areas we see as pretty ripe for disruption. We're also pretty excited about alternative proteins, just in terms of the area around figuring out what's going to be next for just meat. Because the state of affairs right now, it's not something that we're going to be able to sustain. So even if you just predict for China in terms of meat eating right now and take them along the same trend line as a lot of other Asian countries followed, like Taiwan or Japan or whatnot, as they grew over time, the world doesn't have enough agricultural output to actually sustain that level of growth. So we're going to have to figure out something, and it could be that prices go up, meat eating goes down, which seems unlikely, or we'll figure out some other ways of dealing with that. So those are 2 of the sectors that I think are some of the more exciting ones that we see at the moment.
Well, great. Well, in the last few minutes that we have here, what else should we cover that we haven't?
Yeah, so I think one thing, just one piece of advice to different founders in terms of looking at investors. What I find a lot, especially in terms of first-time founders when they first go out, it's like talk to a lot of these different investors. It's all just money coming in. And what I'll say is, I guess, 2 things. One is a lot of investors will talk about all the value that they add, and many just don't. But one thing that I would definitely say is, depending on if you end up choosing the wrong investor and they're there with you for the next 7 years, that could make things very hard for you. So it's just in terms of, it's just like a marriage, right? And if you end up getting on board with the wrong partner, basically it just makes everything harder. So I definitely say, in terms of looking at different partners to work with, in terms of these different spaces, vet them as much as they'd vet you.
Well, that's good advice. How best for the listeners to get back in touch with you?
Yeah, so I can be contacted through the Creative website, and also just because, happy to just give out my email in terms of folks who are interested in connecting. I'm james@creativeventures.vc.
Great. We'll add those to the show notes, and looking forward to having you back for a follow-up soon. Appreciate your taking time. Investor Connect helps investors interested in startup funding. In this podcast series, experienced investors share their experience and advice. You can learn more at investorconnect.org. Paul T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early-stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.